is about a role within the financial markets that I would say largely goes on behind the scenes, that it's not a bank or a clearing firm or an exchange. It's a function that's largely unknown, but it's critical to the operating of the financial markets. The story I like to tell around this is I'll be out at dinner or out in some social function, and I'll be talking to someone, and they'll ask me, so what do you do? And I'll say, I work for a clearinghouse. And the person will go, oh, okay. Like Publishers Clearinghouse? Like you hand out the big cardboard checks and Ed McMahon's walking with you everywhere. So now I've just come to terms with that, and I tell them I'm an architect, so I don't have to answer that question anymore. But no, so little background. So if you aren't familiar with clearing effectively is, in its simplest form, the settling of trades between financial intermediaries. What do I mean by that? A financial intermediary, for us, we typically call them clearing members. A clearing member would be Goldman Sachs, Bank of America, RCG, are all clearing members. To explain what it does, so for example, if you put a trade in with your broker, say it's Fidelity, to buy 100 shares of stock, Fidelity will go down and put that trade down on the market. The exchange will match that with another, someone to take the short side of that. Once that trade's matched, then it gets sent over to a clearinghouse. That clearinghouse then takes the trade and settles it by moving the securities from the seller of the securities to the buyer, and then moving cash from the buyer to the seller. Now, within that process, there's really two key components. There's the settlement of the transaction, so the moving of the cash and the securities. And the other piece, which is largely, which is actually the more important piece, it's the guarantee function. So that if either counterparty, the buyer or the seller, fails to do their part, the clearinghouse steps in and does it. So people can trade with confidence that they're going to get the shares or the cash that they traded on, and they don't have to worry about who they're trading with. I work for the Options Clearing Corporation, OCC. We clear all the stock options. We started off as the Chicago Board Options Exchange's clearinghouse, and back in the early 70s, and as options began increasing popularity, more options exchanges came on. And once that started happening, OCC separated itself from CBOE and became a utility, and we cleared for all the options markets. Ed and Box was probably the last options market we took on. Today we clear for a total of 12 options exchanges, and we've expanded into another 4 futures markets. So clearing itself is largely considered a post-trade or a back office function. This settlement piece is really what people tend to think about. I'd say in the early days, would tend to think about clearing. It's while the guarantee function that I talk about is a real critical part, what people would think of in the past when they talk about clearing is just the moving of securities and cash, keeping that flow going, and really not disrupting that process. You know, that changed, though, very recently as a result of the financial crisis. When you have, you know, banks of the like of Bear Stearns, Lehman Brothers defaulting, now confidence in the markets is an issue, and that process of moving transactions and settling securities for cash is less an issue, and what you're more focused on is really the guarantee function and the risk reducing, making sure that the financial markets can trade and people have confidence in those markets. To illustrate that, we put a short deck together just to kind of talk about what that means. So if you look at the financial market as an ecosystem, you have trading participants, buy side, insurance companies, pension funds, retail customers, hedge funds, mutual funds. When any of these guys are all trading different strategies, they are taking on different positions and interacting in the markets. Typically, these companies are interfacing with the banks in, say, an OTC transaction. Now, to give some context, this OTC market, you know, has been sized to equal about 600 trillion in notional. It's a huge market. That's 10 times, say, the world's GDP. So what you have is a lot of these interfacing in the brokers and banks. And while, you know, what typically happens is a customer trades with a bank. The bank will go and hedge its exposure to the customer. Whatever trade they did with the customer, they'll hedge it off on the other side to flatten out their risk. Occasionally what happens is one of these banks either decides to aggregate the exposure. They want to take it on, earn more profit. Or they might have a problem with their models and they're not measuring their risk right. That's kind of what happened with AIG back in the crisis. And it's what led to a lot of the mortgage-backed securities and the credit default swap issues. So what happens in that scenario in the OTC market is you get a bank taking on too much risk, the market turns against them, and they start taking on losses. The bank taking on the losses, they can absorb losses, but the losses get absorbed through their capital. In the event that, in an extreme case where their capital is not enough to absorb all the loss, the bank becomes insolvent and they go bankrupt. Now, when you talk, say, about a small bank, a small entity, and they go bankrupt, that's not going to be, from a systemic perspective, not the most damaging thing. But when you start thinking of the companies like Bear Stearns, Lehman Brothers, AIG, and they go bankrupt or become insolvent, now what happens in that system, that ecosystem, you lose, that's a lot of the banks, the other banks are trading against those banks, and so then they start losing money. And so you start this contagion, and what you have then is a ripple effect of banks failing. Ultimately, you've got the Fed as the backstop. They would have to step in that scenario and insert liquidity in the markets and help bail out the financial system. The listed markets has a different structure. You've got the banks and the brokers, and you've got the Fed. But what the listed markets have is that layer inserted in between, the clearinghouses. The clearinghouses are there, again, to perform the settlement function. But it's that guarantee function that's more critical, where in the event of a bank or a broker becoming insolvent, it's the job of the clearinghouse to kind of absorb that. The clearinghouse's job is to kind of act as that systemic risk mitigator or a shock absorber. And post-financial crisis, as policymakers looked at what went wrong in the crisis, what went well, what they identified is that piece, that clearinghouse piece in the listed markets performed really well. And it's something that they looked to migrate over as they created the reforms through Dodd-Frank. So what you started seeing is that and this goes to the point of change that I think Ed was talking about, as this market event happened, and the regulators not only are trying to make sure that they prop up the banks and the brokers so that they're have more excess buffer capital, that they have excess and robust risk management processes, but they also started mandating that some of the OTC markets, more of the standardized markets, go on and be required to be ported onto clearing platforms. And so what you have is a real opportunity for clearinghouses and to start really absorbing some of that $6 trillion market, not only making our financial markets safer, but it's an opportunity for the clearinghouses. OCC is one of 7 clearinghouses that have been designated as systemically important. So the Fed and the other regulators have deemed OCC as a clearinghouse, as systemically important. And these 7 clearinghouses really have that opportunity, right? To be the systemic risk mitigator, you have to have significant amounts of capital. You have to have strong risk management processes, and that creates a lot of barriers to entry for a new participant. So if you wanted to start a clearinghouse from scratch, you really are trying to create that capital level. That's very expensive. You don't have the critical mass, and so it's really hard to do. So these clearinghouses really have some kind of an opportunity here. And I guess that's getting to my point in trying to create some excitement for being in financial markets and also thinking about clearing. This is a great time to really enter the market and take advantage of the opportunities available to clearinghouses. As clearinghouses, globally, this is not just a national thing, it's a global thing, start to really enhance their processes, and they're working on various capabilities. For example, building out stress testing capabilities, liquidity risk, model development, compliance and audit. There's lots of roles within the clearing function and opportunities for people that are entering the job market to really enter on the ground floor and start in the financial markets. I've been at OCC for 20 years, and I've been fortunate for the majority of that time. I've been working in the risk management function and developing the framework that supports our market risk, our credit risk, liquidity risk, and default management processes. In risk as an option for people entering the market. you end up interfacing with all aspects of the business, both internally and externally. You're involved in product development as a component of risk management. The company's strategy as a clearinghouse is all centered around risk management. Externally, the risk management function engages with members, banks, and market participants. You're learning about and understanding evolving trading strategies, other risks in the marketplace, and you're providing the market participants with an understanding of how clearing interfaces within their business, and you're actually educating the street. I was very fortunate to have the opportunity to experience a broad spectrum of businesses and remain very curious, as possible about the financial markets and how they operate. In preparing for this presentation, and you heard it from a lot of the market, the earlier presenters and last year's presenters, was innovation in the financial markets. I've not seen in any other market that people innovate so quickly, change and develop new processes. They can turn on a dime, and that's what's really interesting about financial markets. At a clearinghouse, you're introduced into these new innovations because you're critical to the whole infrastructure. And so that's a unique opportunity to contribute and develop financial markets and really stay in tune with these things as they evolved. As I kind of wrap this up today, I want to just leave you with kind of two thoughts. The first one I think a lot of the presenters talked about before, and I'll say it a little bit differently. Stay curious. Remain curious. Always ask questions. Ask how things are working, why they do it that way. And stay intellectually stimulated. When you take a job and you look at other opportunities, think about it from the perspective of, is that job going to keep me intellectually stimulated? Am I going to grow mentally from that? Because that's really what's going to drive you, keep you coming to work in the morning. A paycheck's a paycheck, but if you enjoy coming to work in the morning and enjoy what you're doing, that's what's going to keep you coming. The second piece is really consider the opportunities that Clearinghouse provides for that intellectual stimulation. I think I've been fortunate to accidentally fall into that space. I love it. I think it's a great opportunity. It's a space that people don't know about. When you look at John's job board, look at clearinghouses. There's 3 in Chicago. All of these 3 are systemically important. It's a great opportunity and I think, a good opportunity. I thank you for your time and appreciate being here.